Hello, welcome to Psychological Biases in Investing. So, welcome. I'm going to be talking about several biases that affect decision making, particularly in investing. Okay, so these biases could hinder good decision making, um, and I'm going to try to basically discuss them and as well as talk about some remedies. So, the first thing we're going to be talking about is core emotional biases. Second is pattern seeking and perception biases, social and herding, and also time and decision biases. So core emotional biases, they consist of several things. One's loss aversion, the other's overconfidence bias, self-attribution bias, endowment effect, and regret aversion. So there's like multiple emotions that could hinder us from making solid decisions. So before I talk about loss aversion, I want to talk about something called utility curves. And they're foundational to modern economic theory, right? So a utility curve essentially measures the level of satisfaction of a consumer, investor, or individual. So the higher utility basically means the higher level of satisfaction. Now we could see that we feel less of a gain with $100 then we feel the pain of loss of $100, right? So we're going to feel that pain a lot more. You could see the red lines basically indicating the depth of, I guess, the hurt that we're going to feel, right? As opposed to the gain. So that's the idea of loss aversion. And this particular bias affects our ability to make decisions where we could be actually gaining, right? It could be a net benefit for us to make that decision, especially in the stock market, right? So we might be afraid of losing more than actually gaining more, the upside, right? So what we feel isn't necessarily what's going to play out in the real world, but because of this bias, it'll affect our decision to make that solid decision. So to correct for this, we could reframe losses, right? If we're investing in a stock as losses as temporary fluctuations and not permanent, right? So if we see Apple stock going down, it's a solid stock. We've done our research and our analysis, and we know that it should be increasing. We could just see it as temporary fluctuations, right? And then second, we could use preset stop loss rules or rebalancing strategies to avoid emotional selling, right? So we feel the pain, um, but we could try to mitigate that by setting these rules so that we don't make an emotional decision, right? We pre-establish some rational rule. Okay, we're going to you know sell the stock if this occurs, right? If it hits a certain threshold or whatnot. So here's another bias, the overconfidence bias, and you can see from the graph basically that an overconfident investor that allocates about 15% of their portfolio basically has a increased chance of losing money, right? And that's due to overconfidence in that particular position, right? So you want to calibrate your confidence level to the environment in which you're operating, right? And that confidence level comes from, again, research, in-depth research analysis and whatnot. So in order to mitigate overconfidence, what you can do is keep an investment journal and noting reasons for why you made the decisions that you did, and then review the results later objectively, right? And compare your performance to an index benchmark regularly. Okay. Journals are not just limited to people that invest. I know that, uh, for example, in Korea, there's like a Go master, and basically after every match, Go game or match, he basically analyzes his results to see if the decisions he made were rational, right? Because there are times when we could become overconfident if we see a particular opening or something that will lead us to have some kind of false confidence, right? So we're trying to mitigate that. Um, yeah, so that's basically how you would try to take care of that issue. Um, Here's another one, self-attribution bias. It's a psychological bias where investors attribute their success to skill and their failures to external factors like bad luck or the market, rather than to their own mistakes, right? So if an investor makes a profitable trade, they'll often say that was because of my analysis and timing. If the trade loses money, they might say the market was irrational today or that news event couldn't have been predicted. So they basically pass the buck. We all have this defense mechanism that's tied into how our brains are wired, where we try to kind of not look at um, situations truthfully or objectively, just because of the fact that we've got this defense mechanism built in us to protect us, right? So that's it's natural, but there's obviously some flaws with that because we can't learn, right? So another example to the self-attribution bias would be like, hedge funds, for example, think that their investment skill is what led, is what led to, these outsized gains, right? When in actuality, it could be the Fed's zero interest rate policy that leads to increases in equity prices just naturally, right? This also occurs in venture capital and startups or whatnot. These startup companies in tech. I mean, they think that they're getting funding because they're so great. It could be, but it also could be the fact that it's a zero interest rate policy environment and people just need to spend money at that point, right? A way to mitigate this again is to be humble, analyze the events, and see if skill had anything to do with it, and keep on learning, right? So again, talking about the Go master. Basically, he's just analyzing what he did post mortem, right? So post mortems are always good to combat this self attribution and overconfidence bias. Um, Another bias is the endowment effect, and basically it's saying like you because you own that particular product or stock, you attribute it to being more valuable because of the fact that you own it. Okay, so your willingness to pay for something might be less, right? As you could see in the blue dots in the graph, and your willingness to accept will be more, right? So when you sell your product or stock, you're going to want to sell it for more because you basically own it. Okay? And this is a very irrational uh, behavior in humans. So in order to combat that, what we can do is pretend that you're buying your current holdings fresh today. Would you still buy them? And then also using automated rebalancing to trim oversized positions, okay, in the stock market, right? Because if you automate it, you're not really captured by that endowment effect, right? You're not, you're just looking at it objectively. If it hits a certain threshold where there's too many, you're holding too much of it, you're gonna try to get rid of some. So another one is regret aversion. And you could see that what regret aversion does is actually it's actually pretty costly. So for example, if there's like a stock market dip or whatnot, you're gonna probably wanna, as a regret averse investor, you're probably gonna wanna not take a position, right? Because you see the dip and you're thinking, okay, it's gonna get worse, or it's gonna get worse, so I'm not gonna take it. And you could see that the rational investor will buy the dip. And in the long term, the rational investor will always beat out the regret averse investor, right? Because they're taking rational risks, whereas the regret averse investor is basically saying, hey, if I got, you know, burned on the last position, I'm not going to take it, right? So that has hurtful long-term effects, right, on portfolio value. Um, a way to avoid this regret aversion is basically just to diversify your portfolio, right? So you're not like staking your feelings on one particular stock or one particular market, right? So you could use model portfolios or ETFs to spread the exposure. So again, the blue dot dashed line, regret averse investor skips investing after a price drop to avoid feeling stupid, which means they miss buying opportunities. So now we're going to go into a whole different set of biases, and these are pattern seeking and perception biases. I mean, you're going to see that, at times we're going to, as investors or decision makers, you're going to just see patterns that are not really there, right? And we have these misperceptions because that's just the state of being human, right? We see things that just aren't there, and that's a human foible. So the first one I'd like to talk about is a hot hand or gambler's fallacy. And you could see like when we flip a coin, okay, the baseline rate of flipping a coin is basically 50%. Okay, so it's like heads or tails, right? But when we flip a coin, what ends up happening is like if we see a particular pattern, right, where it's ending up heads all the time, our perception will increase. Okay. Our perception that, a likely head, that it's head will increase, right? And that could be because we're basically imposing what what's occurring in natural phenomena as to be something that will reoccur again and again and again, right? Even though if it's a coin flip and we know the base rate is 50%. Okay. So I'll give another example, and that's basketball, right? We've got Michael Jordan, one of the greatest basketball players of all time. And you think that if he touches the basketball, basically it's an automatic guarantee, right? And that perception comes from the fact that in clutch moments, in key moments, he's made some of the best decisions, right? Where he's won playoff games and championship games. So our perception of his field goal percentage would be like, okay, this guy's got to be hitting like 70, 80%. I mean, that's the way it's perceived, right? In reality, his career field goal percentage was just 49.7%. That's basically flipping a coin. His career playoff field goal percentage was 48.7%. Again, flipping a coin. So here's an actual demo of basketballs, kind of throwing basketballs into a hoop. We get one, we get two, we get three, we get four, and the fifth one we miss. Okay. So, this is what's basically kind of occurring. We see that basically in um, the last shot we just didn't make it, but it would be perceived that it would go in, right? Say if Michael Jordan was shooting the basketball, each time he shot the basketball, maybe the first time we'd be like, oh, is it going to go in? But the first time he hits it, we're thinking, okay, the second time he's definitely going to hit it. The third time there's a more likely chance he's going to hit it and whatnot, right? So each time we make a shot, basically the perceived chance of making another one shot increases. So again, the baseline estimate is 50%, but due to successes, you are miscalibrating probabilities. You're being way over optimistic. If we were to run 1 million simulations, the basketball shots made would be 500,000 or 50%. Okay? And this applies to stock picking and whatnot, right? So if we choose one stock and it succeeds, and the second stop, and that succeeds, we're going to think that we could do this forever, which is, not the case. Here's another bias called recency bias. And basically, what I'm trying to demonstrate in this graph here is that we tend to be pulled into what's happened to us recently as something that will occur again in the future, near future, right? So we extrapolate the present into the future. And this is a bias basically that definitely hurts our decision-making capacity. So like if there was a crash, stock market crash, right, as you could see from the lightly shaded red area, right, the recency biased expectation would be like, okay, because of this crash, it's going to go down, right? The stock is going to go down. The rational investor kind of stays with it though, right? He's going to buy on the dip and whatnot, right? Um, and he basically outperforms in the long run, right? You could see that divergence between the blue and the orange dashed line, right? As to like what a rational expector, uh, what a how a rational investor would perform. So how do you combat this? Obviously, I mean, we look at this linear trend, and it's you're looking at historical data from 10 to 30 years before making assumptions, right? Um, if you just follow this linear line, okay, you would have been way better off because you're looking at the overall trend. You're looking at from 0 to 60 versus from 40 to 45, which the recency biased expectation or recency bias investor would take, right? It's easier said than done because of the fact that when a market does crash, you're psychologically going to feel that, right? And you're not going to be able to look at the data as objectively as you would think, okay? So it is important to write down base rates, like average stock bond returns over the long term, and constantly remind yourself of that, right? So the S&P 500 has always increased historically. Even though when there was like market crashes or whatnot, it's always bounced back and um, always come back to increase more, right? So it's important to really get that history down into your mind. Okay. So now I'm going to be talking about representativeness bias. In this example, there could be in branding, a company markets itself as a blue chip, too big to fail, or innovative. Investors then stereotype it as always safe or always a growth winner, right? So branding will basically get into the minds of people and it'll show itself, and that's the thing that you think of, right? The fact that it's a great company. There's also media stories, headlines like tech stocks are the future, lead people to assume that every new tech IPO is the next Apple or Microsoft, right? So that's another representative bias promulgated by media stories, right? You've got a rough picture of tech, and you think it's just great, right? So that's what that news stories can do. And I mean, it's basically propaganda and herd mentality in bubbles.com, crypto booms. Constant repetition creates a mental shortcut. If it's tech crypto, it must go up. Okay, so everybody talks about crypto now. Like, and they've got their own narrative, I guess, idiosyncratic narrative that goes on in their minds. But it's been a general topic of discussion for many years now that it's just going to go up forever, right? And then that brings in like a herd mentality or whatnot, that could that is not critical. Okay, so so that's something that occurs. So I'm going to give a counterexample of this whole representative bias and something that went wrong because of this particular bias. And there's a company called Enron. It was a corporation, American Energy Commodities and Service Company based in Houston, Texas in the 1990s. It was considered one of the most innovative and fast growing companies in the world at the time. Enron used accounting loopholes and special purpose entities, off balance sheet partnerships to hide massive amounts of debt and losses. This allowed the company to just basically go bankrupt. And in 2001, Enron filed for bankruptcy, and the scandal led to stricter regulations. Investors assumed Enron was a safe bet because it was a Fortune 500 company ranked seventh largest in 2000. It was included in the S&P 500 index, and it was consistently praised in the media as an innovator. This superficial similarity to other strong blue chip companies led investors to ignore warning signs, a classic case of representativeness bias. So, a way to combat this would be basically do your own research. Don't be captured by headline news. Or if you're going to read the news, try to put it into context with your investment ideas or your philosophy. Okay, so you should never be overtaken by the news emotionally. Um, so that would be a way to combat this. Now we're going to be talking about anchoring bias. So usually in stock valuation, equity analysts from investment banks or independent research firms write research reports, usually giving buy, hold, and sell recommendations, right? So they usually give a target price derived from analyzing the firm's balance sheets, income statement, and statement of cash flows. And they'll use these accounting ratios, PE, PB, or DCF analysis to arrive at their conclusions. Okay, so you can see from the evaluation, the green dashed line is basically the true value. The blue dots are different anchors investors might fixate on, like past prices or target prices. And the red dots show how investor biased valuations get pulled toward those anchors. Okay, even though the true value hasn't changed. Okay, so the anchor is kind of it's harmful, right? Especially if you have the wrong one, because you'll be led to undervalue the security or the product price, right? So here's an anchoring bias over time. You can see the true value again and the perceived value, right? And the anchor. So how the anchor basically makes the perceived value decrease hand in hand with it over time. Okay. And again, to correct for these, you have to kind of establish a baseline, right? So, earlier I was talking about the investment banking analysts or the analysts in general that do these set these prices, right? And recommendations for buy, hold, and sell, or sell. They use valuation frameworks like DCF, looking at PE ratios versus history, just instead of gut feel. Okay, so they have a valuation framework that they use to arrive um, at a more accurate intrinsic value of the security issuance. Here's another bias, availability bias. It's tendency of people to rely on information that's easiest to recall, often vivid, recent, or emotionally charged, rather than all relevant data or actual probabilities. Instead of carefully weighing historical studies or probabilities, investors anchor their decisions on stories, headlines, or experiences that come most easily to mind. That's similar to the recency bias that we talked about earlier. And availability bias is a tendency for people to rely on information, right? That's easiest to recall. And I just said that. So that's an important bias. We have a certain set of information that basically um, dictates how we think in the short term, and that's something that we're trying to counter. All right. So in order to do that, we balance personal news sources with objective data. We just don't use one or two data sources, but we use multiple data sources to confirm or disconfirm if this is an anomaly, if the available information at this time is an anomaly, how it fits in with historical records, whether it be through data points or actually narratives. Okay, so also using checklists, right? Looking at the fundamentals um, and seeing if the fundamentals are aligned or how it would affect the fundamentals in the long term. So I'm going to be talking next about social and herding biases, right? And this is something that humans are prone to as well, right? We're always looking for comfort in a certain sense, and in groups we find comfort. So we've got that herding behavior that we all have experienced at one point, right? It's easier to do things in a group, okay? We see riots, people are engaging in behavior that they wouldn't usually engage in if when they're with a group of people. So that's a natural condition of the human being of humans, right? So how would we combat this? Like you know, before you jump into kind of a trend or whatnot, you should define your investment strategy in writing and revisit that, okay, before chasing anything that might be temporary, a temporary trend, right? Mm, Automate contributions, dollar cost averaging, so you buy or sell regardless of the hype. So another bias that we have is narrative bias, and instead of like looking at a graph of a stock drop or some trend, we actually get these through newspapers. So, for example, artificial intelligence. Investors follow compelling stories. AI is the future, so all AI stocks must go up. often because the story spreads socially and becomes a shared belief. Okay, so this makes it similar to herding, though rooted in our brain's preference for stories over statistics. Okay, and that is something that also people should be wary about. Like the reason why we have numbers is that it's the closest thing we can get to objective truth. Narratives are prone to, exaggeration, inaccuracy, and whatnot. So it's always good to have a counterbalance to basically these stories with objective numbers. Um, One way to do that would be just to solely look at polls, right? Like YouGov is a good polling company, to see if something like AI is actually popular or spreading, right? And you could see maybe they do polls. I'm not sure if this is true or not, but maybe they do polls with young people or people in the tech sector to see how they view the rise of artificial intelligence, right? Versus just a normal news outlet or the average citizen. Okay. So another one is authority bias, right? And authority bias usually attributes expertise to people when it doesn't exist. Okay, so these guys are basically experts. Like you've got two experts in technology, one in investments, but you wouldn't look to any of these guys for medical advice, right? But due to the fact that they have some type of domain expertise in one area and they are widely popular, uh, it leads people to believe they are credible in other domains as well. Okay, so even though they might not have medical expertise for some reason or the other, because they are authorities to some respect, they people will listen to them or believe what they have to say. Okay, um, and this is pretty easy to combat. I think this isn't a bias. One needs to just do the research in the topic and domain and get other dissenting opinions to either disconfirm or confirm arguments or positions made by people in authority. Okay, so being an independent thinker is a valuable thing, and yeah, so that's what I would say. Another one is confirmation bias. This is usually something that occurs um, within ourselves as well, right? Um, there's all this overwhelming disproof, right? And we tend to have this tendency as people, human beings, to ignore all of it and just kind of rely on, say, a single supporting fact. One single supporting fact could, you know, be used basically to support our own conclusions, right? And we'll we'll ignore everything else, right? And we'll ignore contradictory evidence. So this is something that occurs a lot. I think self-awareness is the tool to combat this. Okay. Now I'm going to be talking about time biases, and then the last thing that I'll be talking about is decision biases. So there's something called present bias, hyperbolic discounting, right? And it's basically weighing the present more than the future, or thinking about the present more than the future, right? So looking at the cartoon, basically, it's basically saying, hey, I'm just going to take the car today, that little toy today, right? When I could have 20 or 30 toys tomorrow. Okay, so we're always weighing the present more and we're discounting the future. Okay, we're always discounting the future a lot more. Okay, so that's a dangerous trait. We don't save for our retirements because we're looking at today and a host of other behaviors, undesirable behaviors, right? So overvaluing immediate rewards relative to future ones. And another example, selling stocks too early for a small gain instead of holding for larger long-term returns. Obviously, there's short-term thinking involved in that as well. And companies investors focus on quarterly earnings instead of long-term growth. That's something that's common. Um, with Donald Trump as president, he's focusing on getting it to 6 months. Maybe that will be beneficial, right? 6 months earnings instead of quarterly earnings, where the CEO will look at the company from a more long-term perspective. Maybe that would mitigate layoffs or whatnot. I'm not sure. But a counterexample to this is Jeff Bezos of Amazon. Okay, so in 1997, shareholder, famous in business schools, Bezos explicitly stated that Amazon would make investment decisions in light of long-term market leadership considerations rather than short-term profitability considerations. Okay. Analysts in Wall Street often complained Amazon was overvalued because earnings were tiny relative to its market cap, but Bezos framed cash flow and long-term value creation as the real measures, not quarterly EPS. And he was very open about volatility. We will continue to make investment decisions in light of long-term market leadership considerations rather than short-term Wall Street reactions. So that kind of gives you a good way of looking at how you should frame um, decisions in term with respect to time. Okay. Finally, I'm going to be talking about decision biases. The first thing that comes to mind with decision biases is mental accounting. And you can see that um, we treat money that we worked really hard for differently than, say, how we would treat money if we won the money gambling, right? Um, and that could also apply to investing. And we would treat it basically not as real money, right? If we won money in investing, because it's perceived as like we didn't really work for it or whatnot, we would have this kind of bias and say, okay, this is separate. This money is separate. It doesn't really count as real money because we didn't really work hard for it. Okay. Um, and that's an issue, especially if you're an investor, right? Like if you win money and then immediately because you won, you're like, okay, let me just take that money out because it's not real money, right? It's not in my bank account. It might be in my stock portfolio account. Um, and you would make a bad decision from that, right? So how can we combat something like that? We could consolidate all investments um, into one dashboard and try to look at it from a holistic perspective. Our finances from the stepping back and looking at it from a more holistic sense, right? And we treat all dollars equally. Think in terms of total portfolio return, not dividends versus capital gains. Okay, so that's another thing that we could possibly do some mental accounting with, right? We're going, oh yeah, we we did, we got capital gains, we got dividend cash flows, and that's not real money, right? So we have to combat that. I'm going to be talking about now disposition effect. And that's a confluence of biases. And it's usually like disposition is selling winners early and holding onto losers too long, right? So that's usually the outcome of the disposition effect. And what are the biases? First is loss aversion, right? So losses hurt more than equivalent gains feel good. We saw that earlier. And selling a losing stock means locking in the pain, so investors avoid it. Selling a winning stock feels good because it turns paper gains into realized gains, right? So there's loss aversion that's attached to that. Then there's mental accounting, right? Investors treat each stock as a separate account. Closing a long position feels like admitting failure in that account. And then self-attribution bias. People attribute wins to their skill, eager to sell and prove they were right. They attribute losses to bad luck, hold longer, hoping it turns around and redeems them. So there is a confluence of biases that affect this particular behavior. Okay, it's good to keep track of this. Self-awareness again is usually a good one of the good tools. Another is rebalancing rules, right? Selling overweight winners, trimming the underperformers. Okay, track after tax, after free fee total returns to evaluate positions objectively and not look at it from a mental accounting perspective. Finally, the last thing I'm going to be talking about is survivorship bias. And you could see from the illustration basically a graveyard and then basically buildings on top. Graveyard representing like all the companies that have basically died, and we don't see these, right? We only see the good ones, the ones that are thriving and surviving, right? Um, Investment analysts only see the companies that survived, not the thousands that have failed, right? So strong or average PE, price earnings, price book, return on equity, earnings per share, these are all metrics that failed companies had at one point, right? So they had average or strong, accounting. Uh, they had average or strong balance sheets, and that's not something that obviously is something that's an issue when companies are thriving. But it didn't give an indication as to like why it failed, right? And also, when investment analysts look at data sets, they're not looking at failed companies, right? Um, they exclude those companies, giving an unreliable weighting on the metrics that may or may not indicate company strength. So it doesn't necessarily mean if you have data sets filled with companies that have these accounting ratios that they're going to survive or not. A way to combat this would be using unbiased data sets, right? So include the delisted companies, funds in backtests. You could use that. You could do that by using data sets from CRISP, Morningstar Direct. They maintain these survivorship bias-free databases, and then ask what's missing, right? When you see stellar performance stats, check if they report since inception, right? It may exclude dead funds, okay, from the mutual fund perspective. And then diversify. Avoid putting faith in a few winners. Survivorship bias makes the winners look more common than they are. And then historical perspective, remember examples like Lehman Brothers, Bear Stearns, or Enron. Once they were prestigious, now they are gone, right? They had solid financials, okay? So this is a good way of analyzing data sets in general, is that you should look at these data sets and say, what is missing, okay? Before you accept what your, say your statistical models or whatnot will run on these data sets, you should understand the data inside and out. Look at the weaknesses, look at the strengths, and make sure that what you're looking at is what you actually think it is. So here's the conclusion. Practical tools that help checklists. Um, Automation, dollar cost averaging, auto rebalancing, adding to your retirement contributions. Pre-commitment devices before you make a decision, right? Uh, which are like written investment policy statements to prevent emotional driven trades. Obviously, machine learning and statistical modeling, where we develop hypotheses and build features around those hypotheses um, to add to our models, right? If you're really thinking about it clearly, machine learning and statistical modeling are pretty rational ways to invest, right? You're pre-selecting all the possible factors that could influence an outcome to the best of your knowledge, and you're formalizing it. So when these models um, output a decision, whether it's binary or whether it's a continuous type of outcome, it'll give you an objective, the most objective uh, evaluation, right? And then diversification, it reduces regret and loss aversion and the emotional weight of single positions, okay? And then finally, you could have behavioral coaching. Financial advisors increasingly act as bias coaches, keeping clients disciplined. It's always good to have a second opinion outside of your own. So that wraps it up. Thank you very much, and I hope you have a good day.